CSP Inc. reported Q3 2026 earnings today, and while there was no Wall Street consensus estimate to beat or miss, the print definitely showed a clear year-over-year contraction.
Yeah, revenue fell 6.5% down to $14.4 million. And the EPS, well, that came in at a net loss of 9 cents per share.
Which is widening, right, from the 3-cent loss they had last year.
Exactly. Widening losses. Plus, management's forward guidance actually warned that hardware supply constraints are going to persist for at least another 12 months.
Right, and the market clearly didn't love that. The stock dropped about 4% to settle near $8 or 4 cents. But if you look under the hood, there is this massive margin paradox going on.
Oh, you mean the gross margin improvement?
Yeah, like top-line revenue fell, yet total gross margin actually improved by 130 basis points to 30.1%.
Right, and product gross margins jumped to 20.7%. Breaking down the segment split kind of explains that shift, though. I mean, product revenue only dipped slightly to $9.9 million.
But service revenue took a way heavier hit.
Yeah, exactly, dropping 16% down to $4.5 million.
Wait, so if management's whole stated strategy relies on pivoting toward high-margin services, isn't a 16% drop in that exact segment a massive red flag? Like, isn't that supposed to be their growth engine?
It totally looks that way on the surface, sure. But the causality here is tied entirely to severe industry-wide hardware bottlenecks.
So they're just literally waiting on parts.
Right. Equipment lead times have stretched from historical norms of, 30 to 60 days to over 200 days now.
Wow. Over 200 days.
Yeah.
So they're essentially a high-end contractor waiting on lumber. Like, you can't bill the client for installing a network if the physical servers take 200 days to even arrive at the site.
Precisely. The hardware delay is literally stalling CSPI's ability to recognize the attached service revenue.
Right.
I mean, the demand hasn't vanished. The company just can't fulfill it until the equipment actually ships.
Which means all that delay revenue is just building up in the pipeline right now.
Right. And that bottleneck totally explains management's bright spots. Their technology solutions backlog surged 65% year over year.
That is a massive jump.
It really is. Furthermore, the AZT Protect cybersecurity unit boasts a 100% renewal rate. And they have several six-figure enterprise deals nearing the finish line of their, really long 18 to 24-month sales cycles.
Well, AZT Protect boasts that 100% renewal rate because cybersecurity just isn't a discretionary spend you can easily pause. Once you integrate a system like that, ripping it out is way more painful than keeping it.
Right, it creates a massive moat.
Exactly, a moat of future recurring revenue. But, looking at their balance sheet, you still have to weigh the near-term risks. Operating expenses are rising fast.
Yeah, driven heavily by R&D investments and that one-time UK pension buyout.
Plus, there's significant customer concentration risk, right? One single client represents 10% of their accounts receivable. Any disruption there hits the bottom line really hard while they wait out these 200-day delays.
True, but to their credit, the balance sheet remains a definitive point of strength here. CSPI still retains $24.7 million in cash.
Which is a pretty solid cushion.
Definitely. And they maintained their 3-cent quarterly dividend and even executed share repurchases. That heavily signals management's confidence in their own liquidity.
So because of that massive 65% backlog, CSPI basically looks like water building up behind a dam. The potential energy is all there, just waiting for the hardware delays to clear.
It just comes down to timing, yeah.
Right, but that leaves you with a much bigger question to mull over. The real issue isn't just whether CSPI's clients will wait out this delay without canceling their orders.
It's what happens if it's permanent.
Exactly. What happens to the broader tech sector if these 200-day lead times become the new permanent reality? Will enterprise companies be forced to change how they budget and deploy IT infrastructure entirely?
That is a huge question.
It really is. Make sure you follow the show for daily earnings coverage.